Promises of making quick money and getting rich fast through day trading are everywhere on the internet. But what exactly is day trading? A request came in from the community to create a video on the topic of day trading. That's why today we'll discuss what day trading is, how it works, the chances of success, what the risks are, and why it's so popular. At the end, we'll also consider whether day trading makes sense for a long-term investor. Hi, my name is Sean, and I explain helpful insights from the financial world. The topic of day trading, or simply trading, is very emotionally charged. On the one hand, you'll find many so-called gurus who claim to have made enormous amounts of money through day trading and want to show you how to do the same. On the other hand, there are countless scarred victims in forums who have lost their entire fortune to day trading and in the worst case have even accumulated debts. To avoid emotional discussions, let's start with a definition of what a day trader actually is. A day trader is someone who engages in day trading, which is essentially the short-term speculation of securities. A trader opens a security position within a day, so they buy securities and sell them again within the same day. This is where the term day trader comes from, because the trader only trades during the day and closes all positions by the end of the trading day, leaving them with 100% cash. Compared to monthly or yearly price changes, price fluctuations within a single day are relatively small, and big jumps are rare. So to actually profit from these small fluctuations, day traders often use leverage. Now, leverage involves borrowing money from their broker or bank to amplify potential profits. With borrowed capital, day traders can achieve nearly unlimited leverage, for example, buying 1 share themselves and 100 shares on loan. This enables them to profit from even the smallest price movements during the day, but also exposes them to the risk of losing borrowed money. So now that we understand leverage, let's look at the types of products and markets most day traders operate in. Most private day traders primarily trade derivatives rather than direct underlying assets. They often trade products like futures, options, binary options, or CFDs, which is short for contracts for difference. These products are preferable because they allow for better leverage and require less upfront capital. While some traders exclusively trade stocks, this is less common because it requires more capital to make an actual impact. As explained in my video about derivatives, derivatives are derived from an underlying asset. So what underlying assets are day traders dealing with? The underlying assets day traders usually trade include stocks, but more commonly, they trade in the Forex market. Forex, or foreign exchange, is the world's largest financial market and deals with currency pairs. For example, when you hear that the euro has lost value against the US dollar, or that the British pound has gained against the yen, that's the Forex market that's being talked about. It is the largest and most efficient financial market with the highest transaction volume. Now that we know what day traders trade, let's look at how they trade. A day trader has 2 main options: taking a long position or a short position. A long position involves betting on rising prices. For example, if a trader takes a long position on a stock, they buy it in hopes that its price will increase. A short position involves betting on falling prices. Here, the trader sells an asset they don't yet own and later buys it back. This process, known as short selling, can sound complex, but it is essentially just borrowing the asset to sell it up front and later buying it back and returning it to the original owner. This is a so-called lending transaction. This may sound a little complicated, but the important thing here is to have at least heard the 2 terms long and short. So how does a day trader decide whether to take a long or short position? For this, there are a couple strategies. One is called event trading. Event trading focuses on specific events occurring during the day, such as published labor market data from the US or Germany, or even economic forecasts and interest rate decisions, or perhaps big economic or political announcements like elections for a country, or another Brexit or military conflict. The trader then forms a hypothesis or belief about how these events will unfold. For example, if they believe a company will report better sales than expected, they'll take a long position because they anticipate that there will be a price increase. If they think, for example, iPhone sales for Apple will decline more than expected, they'll short Apple. Of course, they won't always be right, but the key is to be right more often or invest more in winning trades than in losing ones. Now that we know how trading works, let's look at a couple motivation reasons explaining why so many people have become interested in this topic. One major motivation is the dream of easy money and getting rich fast, because large sums of money can change hands quickly in trading. There's always the hope of a big amount of money landing in your account. And many trading gurus you see online push this dream to try to motivate you to start day trading. But this is a sketchy practice. People who promote day trading do so because they are incentivized by trading platforms as they earn a large amount of commission from people creating accounts on these trading platforms. Here are some examples of the thousands of dollars people get paid to refer traders to different platforms. And here are the exact same platforms but showing the disclaimer statistics of how many people end up losing money. It's often even 70 to 90%. They want people to trade actively, buying and selling, in order to constantly generate transaction fees for the broker, and most end up actually losing their money, which I'll explain a bit more later. Another reason is the low barrier to entry. Anyone can try day trading. There's no specific education, degree, or certification required. You can simply open an account with a broker and start trading with your own money. However, this also means many people underestimate the risks given it's so easy to start. Anyone that wants to start day trading must realize the reality that you're competing against major financial players like banks that employ teams of highly trained traders with better information and technology to be able to trade way faster than you likely will. You'll also need excellent technical equipment and a super fast internet connection, as even slight delays can melt away your profits or even result in losses. Another big problem is that retail traders risk developing a gambling-like addiction, which can lead to financial ruin. Additionally, day trading generates high transaction costs. Every time you buy or sell something, you have to pay fees to the broker. These fees really eat into any profits and must also be covered in addition to any losses that you make. You should also think about the point I mentioned earlier that you have very strong opponents, namely the largest investment banks in the world. Since there is no added value in trading as it's money transferred from one side to another, there are always losers wherever there are winners. The money you lose with your trading is in someone else's pocket, and the money you gain is lost by someone else. It's one of the many ways where trading is quite frankly very similar to gambling and not with great odds of success. According to a 2017 study from the University of Berkeley, it was found that up to 80% of trades were unprofitable. 77% of retail traders incur losses. Among those who do make gains, the average annual profit is only $22,000. Not a very impressive figure for those hoping to gain wealth quickly. And actually, those people profiting are actually underperforming the market. In another study, they found that traders who traded and earned on average the most achieved 11.4% annual return, while the market returned 17.9% for the same time period. Only 1 to 3% of traders were able to consistently outperform the market. For more than 97% of people, it would have been better just investing broadly in an ETF tracking the S&P 500 or some other broad index like the MSCI World. This index investing style would just take 3 hours a year versus the full-time, high-stress job that day trading creates for you. So if you're considering day trading, be aware that it's not a hobby, but a full-time job. This requires extensive training and education and significant upfront learning losses. Remember, your competitors include the largest banks in the world, equipped with experienced professionals and advanced technology and information that you will likely never have. If you still want to dip your toes into day trading, consider using a demo account offered by brokers. These accounts allow you to test your skills without risking real money. But if, like me, you prefer to build long-term wealth with greater security and stability, without constantly staring at your screen trying to keep up with the markets, then you might want to check out a playlist of videos I made on passive investing. Elsewise, if you enjoyed this video, then you might want to check out this video here to know more about stocks and stock exchanges than 90% of people in under 10 minutes. Thanks so much for watching, have a great day, and see you in the next video, which you'll totally want to click right here. Do it.